Must know investing and annuity key terms that can definitely impact you. My name is David Lumberg. I'm a fiduciary wealth advisor and tax planner, also owner of Awaken Financial Designs, also have a double master's as well as a Marine combat veteran here as well. And I just want to share with you years of experiences on what so many people, even advisors themselves, don't understand about these keywords below and how they work with annuities and investing with examples along the way. So when it comes to annuities, now annuities are usually created by a life insurance company and not a brokerage firm. Now I will be go over in addition on here is the fixed annuities, not variable annuities, which are very different, but fixed annuities like fixed index annuities or fixed annuities together and these key terms that do apply. Now, number one here is what is a locked in term? Now, it's a set rate or limit that is locked in for the duration of the annuity. Example, you have a 7-year term annuity, and maybe on there, one of the allocations you have a choice of is locking in a cap of 8% for each of 7 years. What that means is year one, your cap is 8, year 3, it's 8, year 5, it's 8, year 7, 8. No matter what happens, you're locking in that guaranteed cap for the life of that annuity on there. So be sure you check out for locked in terms on different annuities. Number two, a cap. A cap is the highest interest credit that could be earned. Now, a cap is like a ceiling. Now, let's just use an example, the S&P 500, or you can use the triple Qs or the NASDAQ. We'll say S&P 500 as most are aware of that. If it has a 7% cap, it means that during your own 12-month or anniversary year, let's say from January to January, if the S&P 500 goes higher than say 7% your cap, you can only get up to 7%. So if the S&P does 12%, you don't get 12, you only get 7. If the S&P only does 4%, then you would get 4%. So the cap is the most you could earn depending on the performance of that index. Trigger, so what is a trigger rate? If an index, as example, is 0% or more, then you're credited a set rate. So maybe it has an S&P 500 trigger option. So in your own 12-month period, as long as the S&P 500 ends at 0% or higher, that's the trigger, they will auto round you or auto credit you a set amount. So in this case, let's say again, 7%. So the S&P 500 ended at 0%, that trigger turns on, you're auto rounded up to 7%. Maybe the S&P 500 only did 3% that year. You still get the full 7. Maybe it did 6%. You still get the full 7. So that is what a trigger rate is. The par or the participation rate that so many see is a percentage of an index or credit that could be received. You could be 40%, could be 180%. What you need to understand is, again, using the S&P 500, say ETF or index as an example on here, is that if it has a par rate of 100%, that means you get 1-for-1 to the S&P 500. So wherever the S&P 500 does in performance, you get 100% of that credited to you. However, if it's only a 40% par rate, that means during your 12-month period, when that ends, you only get 40% of the credit the S&P 500 did. So let's just say if it did a 10% that year, at a 40% par rate, you'd only going to have a 4% credit. Now, maybe you have a 150% par or participation rate. That means you would get 150%, as an example, of whatever the index performed for that given year. Now, a bailout is a minimum interest or credit rate that if it falls below, you can withdraw or surrender the policy. So as an example on here again, maybe you have the S&P 500 and it starts off at a high cap, 10%. But maybe it has a bailout rate of 4%. So during that term period or your annuity, if the company ever drops it below 4%, which is the bailout rate, then you now have the right to bail out or cancel or terminate that annuity with no annuity penalties because they have breached the bailout rate. We also have a set interest rate, kind of like a CD, where they might say, hey, for this given year, you get 3%, or for this next given year, you're given 5%, just a fixed rate. The term year, at the end of your own anniversary policy year. So if your policy started in February, then you're February to February, started October, you're October to October, the rates can be changed. So a lot of times you see these high caps, high pars, high trigger rates, but majority of the time, they're only good for that first year period of your own policy. Those rates can change. They can go higher, they could stay as is, or they can go lower. So before you get that annuity, please be sure to see, hey, how can these future rates change possibly? Is there a bailout rate? What has happened in the history on here? So pay attention to that. Also, fees and riders, always look for all fees involved, whether it's fees from the annuity, fees from the actual investments or allocations, or if you have riders, which are like add-ons on there, income rider or long-term care rider, those also have fees. Sometimes they could be good, sometimes they could be bad, depends on your own situation, but be aware of the fees and the riders. And the last big one you want to know of is the free withdrawals. That's a percentage you can take out of your own annuity each contract anniversary year without additional annuity fees. Most companies, they will let you take out 10% of the entire account value after your first full year has elapsed. So that means after year one, if you wanted to take out up to 10% of the account value, you could do so, and there are no annuity penalties or annuity fees for that. Same thing in year 2 or year 5, just the ratio term. Now, if you take out more than, say, that 10%, that free withdrawal period, the annuity company will charge you a fee for taking out more than that 10%, which is during that free withdrawal. Now, say if it's a 5-year annuity, year 1, that fee is going to be higher. As it gets closer to year 5, the end of the annuity, the fee will be much lower. So you want to be aware of the free withdrawal limits as well. Now, these are just some of the main terms on here regarding these fixed annuities or annuities in general to give you more education, to give you more awareness. That way, if you ever look at an annuity again or someone's talking about annuity, you know these keywords and examples of how they work. It's your money on there as always, so make sure you choose to invest wisely. We're always here to ask questions. Thank you so much.